Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So it is late May 2026, and we actually have a shockingly warm bank holiday weekend here in the UK.
I know, everyone is running straight for the garden.
Yeah, exactly. But if you work in retail banking, the regulatory agenda right now is, frankly, anything but relaxing.
Oh, it is completely boiling over.
It really is. I mean, we are looking at an unprecedented collision of regulatory reforms, technological upheaval, and shifting compliance standards all hitting the sector at once.
Yeah, the sheer volume of paper we've got on the table today is staggering.
Right. We've got HM Treasury policy statements, Bank of England and FCA consultations, a fresh penalty notice from OFSI.
Plus the Bohurst AI 100 report and industry coverage from Citi AM and RegTalkUK.
Exactly. And the macro environment is just as tense. April borrowing just hit £24.3 billion, which is a COVID-era high.
Yeah, and debt interest alone was a record $10.3 billion for April.
Plus, you have the Iran conflict pushing energy prices and gilt yields higher. Retail sales fell 1.3% in April, though Chancellor Reeves did just announce that £300 million Great British Summer Savings VAT package.
Right. And even the good news has a bit of an edge. I mean, Nationwide announced a £100 member bonus, but their pre-tax profits actually dipped to $1.49 billion.
Yeah, there is a lot moving. The FCA just opened its scale-up unit to solo-regulated firms, and the UK's largest ever U.S. business delegation just launched in Los Angeles.
It is a phenomenal amount of change. But, the real story here is how these dense regulatory documents actually map out the future of money.
Right.
We are watching 50-year-old consumer laws get thrown out the window at the exact same moment that futuristic AI algorithms are tearing up bank operating models.
So let's jump right into the biggest structural shift hitting retail banking. The 1974 Consumer Credit Act is, well, it is dead.
Finally. Yeah, it is being repealed under the new Financial Services and Markets Bill.
Right. We are tossing out a 52-year-old rulebook, and the core requirements are moving straight into the FCA rulebook.
Which is a massive relief to lenders, to be honest.
But if you are listening to this and you actually handle compliance, you know this is not happening in a vacuum.
Oh, definitely not.
I mean, I checked the 10th regulatory initiatives grid before we started recording. There are currently 135 live initiatives.
Yeah, resource triage is basically the defining challenge for compliance teams right now.
Right, because Buy Now, Pay Later Regulation Day is set for the 15th of July, 2026. You are layering the total repeal of the CCA on top of mortgage rule reviews and the smart data interfaces rollout.
It is a lot. But to understand why repealing the CCA is so monumental, you have to look at the mechanics of what the Treasury calls all-or-nothing automatic sanctions.
Which were brutal.
Absolutely brutal. The 1974 law was written for an era of physical paper forms and high street branch visits. It was incredibly prescriptive.
Right, rigid pre-contract disclosure templates.
Exactly. Under the old regime, if a lender made a minor administrative typo or used the wrong font size on page 4 of a contract, it triggered an automatic sanction.
Wow.
Yeah, the entire debt became legally unenforceable without a specific court order, and the firm lost the right to charge any interest. It cost firms millions over the decades.
I always thought of the old CCA as sort of an automatic tripwire. It detonates the entire building just because someone stepped on a blade of grass.
That is a great way to put it.
Right, and now we are shifting to the FCA regime, which operates a bit more like a smart security guard who actually assesses if a threat is real.
Yeah, Economic Secretary Rachel Blake is calling it a flexible regime fit for the digital age.
Because the burden of proof shifts heavily toward the consumer duty, right?
Exactly. The Financial Ombudsman Service will handle redress based on the actual harm a consumer suffered, rather than penalizing a firm for a technical formatting error.
Which has a massive real-world impact on financial inclusion. I was looking at the literacy trust data in our sources.
Those are the reading age stats.
Yeah. 1 in 7 UK adults has the reading age of a 9 to 11-year-old. That some of the previous statutory credit terms required a reading age of over 20.
Which is absurd. When the law mandates highly technical legal jargon, it is not protecting the consumer, it is alienating them.
Right. So ditching that rigid text allows firms to design mobile-friendly, accessible disclosures that people can actually read on their phones.
And it removes the strict statutory terminology around words like interest, which was a massive headache for Islamic finance providers trying to offer Sharia-compliant products.
So it promotes genuine market inclusion. But look, I have to push back on the framing here.
Okay, go on.
The government calls it modernization. But if you remove those statutory tripwires, aren't you just lowering the drawbridge for bad actors?
Wow.
I mean, from a critical perspective, this looks a lot like deregulation wrapped in the friendly branding of a digital update.
And consumer groups share that exact concern. Moving from hard rules to flexible principles always carries the risk of exploitation. But the government did compromise. They kept several red lines as criminal offenses to maintain a deterrent.
Like what?
Canvassing off trade premises, which essentially means high-pressure doorstep selling, that remains a criminal offense.
Right.
Targeting minors with credit circulars is still criminal, as are the strict rules surrounding pawnbroking.
Okay, so they kept the teeth where the risk to vulnerable people is highest.
Spot on.
Yeah.
But the day-to-day administrative burden for standard lending is significantly lightened.
Right, but here is the irony. The government is demanding banks implement this massive, nuanced, outcomes-based consumer duty regime. But the banks themselves are drastically updating their workforces for the AI era.
By getting rid of humans.
Exactly. They're firing the very people expected to manage this compliance transition. Standard Chartered announced they are cutting 7,000 roles by 2030.
Yeah, and their CEO explicitly targeted what he called lower-value human capital for replacement by AI.
Lower-value human capital. That is a remarkably blunt way for a chief executive to describe employees.
It really is. And HSBC CEO Georges Elhidary warned staff that generative AI will, quote, destroy certain jobs, though he did argue it will create no ones.
But the data is undeniable. The Bowhurst AI 100 report shows the UK now has 23 AI unicorns, with fintech leading the charge in practical adoption.
We are way past the theoretical phase of artificial intelligence now.
Yeah.
This is active, aggressive deployment.
And frankly, some of it looks reckless. Look at the U.S. fintech bolt. Their CEO, Ryan Breslow, recently scrapped his entire human resources department.
So axes the whole thing.
Fired everyone, replaced them with the tiny people operations team, claiming that HR was creating problems that didn't exist.
Wow.
But let's look at the financial context missing from his tech visionary narrative. Bolt's valuation had recently cratered from $11 billion down to $300 million.
So this AI-centric efficiency looks suspiciously like frantic cost-cutting masquerading as innovation.
Exactly. And this brings us to a massive regulatory tension for anyone working in the UK under the Senior Managers and Certification Regime, the SM and CR.
Right, because for anyone managing risk, the SM and CR is the absolute bedrock of accountability.
You need a designated human, a senior manager, to take personal legal responsibility.
Exactly.
So if a firm acts as its HR department, which is often the first line of defense, who is tracking conduct breaches? Who manages fitness and propriety assessments for traders?
Well, that is the million-dollar question. You can automate a spreadsheet or use a chatbot for holiday requests, but you absolutely cannot automate accountability to the FTA.
Exactly. If a rogue employee slips through because an algorithm failed to verify their references properly, a senior manager cannot sit in front of a regulatory tribunal and blame the software code.
They cannot. The algorithm does not get fined, and it certainly does not go to prison. The senior manager does.
Which is why stripping out personnel just to save on payroll creates a fundamentally brittle organization.
Yeah, it is short-term efficiency achieved by sacrificing long-term resilience.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
Now, speaking of sacrificing resilience, we need to talk about the ring fence.
Right, because banks are hollowing out their compliance and back office teams with AI. At the exact same moment, the government is actively encouraging them to take on exponentially more risk.
Yeah. The government's new Safeguarding Stability, Enabling Growth review is essentially poking massive holes in the ring fence.
Which is the ultimate post-2008 banking defense. We forced banks to structurally separate their everyday retail deposits from their high-risk investment banking side.
It was a structural circuit breaker. So if a bank's trading desk blew up, ordinary depositors wouldn't be dragged down with it.
We spent years building this massive, impenetrable firewall to protect retail deposits, and now the government is essentially installing a beautifully painted 80 billion pound door right in the middle of it.
That is a very visual way to put it, but yeah. They're calling it the new growth allowance.
Okay, break that down for us.
So the primary core deposit threshold remains at £35 billion. That determines who actually has to ring fence.
Right, and the Treasury will review that again in 2028.
Exactly. But the big news is this new growth allowance. Ring-fenced retail banks can now use up to 10% of their Pillar 1 risk-weighted assets for activities that were previously strictly prohibited.
And just to clarify, Pillar 1 risk-weighted assets, this isn't pocket change. This is the core mandatory capital a bank must hold against its specific risk profile.
Right. They're dipping into the structural foundation of the bank to fund new ventures. It unlocks up to £80 billion of new financing.
For what, exactly?
Well, the goal is to allow retail banks to lend directly to the British Business Bank and the National Wealth Fund, funneling capital into UK businesses and infrastructure.
Oh, I see.
It also lets retail arms offer vanilla derivatives to growing businesses so they can hedge against interest rate risks without going to an investment bank.
Okay, but this capital injection isn't free. How is the Treasury paying for it?
By reforming the foreign branch's tax exemption.
Ah, the rule allowing multinational corporations to offset overseas losses against UK tax liability.
Exactly. By reforming that, the government extracts hundreds of millions a year from international banking groups to fund this.
And how are the critics reacting to this kind of blatant industrial policy?
With severe alarm. Experts are warning this is a politically driven attempt to extract credit for economic growth. Retail deposit funding is cheaper than wholesale funding, and the government wants to leverage that.
But hardwiring retail banks into industrial policy blurs those post-2008 safety lines.
Spot on. And the Bank of England recognizes the danger. They've committed to reviewing their calibration of the internal MRAL scaler.
Which, in plain English, means the emergency cash cushion a bank is legally required to keep on hand to absorb losses.
Precisely. The Bank of England is signaling that if retail banks take on more risk, they might be forced to increase that emergency cushion. It is a very delicate balancing act.
Yeah, and the government doesn't just want this $80 billion unlock, they want it moving faster and more efficiently. Which brings us to the actual plumbing of the financial system.
Tokenization and the push for 24/7 settlement.
Right. The FCA and the Bank of England just issued a joint call for input on wholesale tokenization.
Yeah, the regulatory architecture for the digital asset world is finally solidifying. The Prudential Regulation Authority confirmed that tokenized traditional assets will receive equivalent prudential treatment to their non-tokenized equivalents.
As long as the underlying risks remain the same, which is a massive confidence boost for the market.
Exactly. And for retail banks issuing stablecoins, the PRA now mandates they must use insolvency remote entities.
Let's explain why that matters. An insolvency remote entity means the stablecoin operation is legally walled off from the rest of the bank, right?
Yeah, so if the crypto venture collapses, it does not drag the core bank into bankruptcy. Plus, it stops consumers from mistakenly assuming their digital tokens are protected by the FSCS.
Which perfectly sets up the Treasury's Digi pilot.
The digital gold issuance, yeah. The government wants to issue digitally native UK sovereign debt with on-chain settlement.
But for digital markets to function, the money must move when the markets are open, and in a tokenized world, markets do not close.
Never.
So, to support this, the Bank of England is consulting on extending the operating hours of RTGS and CHAPTIS. Starting in September 2027, CHAPTIS will open at 1:30 in the morning.
Instead of 6 a.m.
Right. And the long-term plan, Sunday and bank holiday settlement by 2029 and 22 hours a day, 6 days a week by 2031.
If you are a risk or liquidity manager listening to this, that completely upends the traditional mechanics of your banking day.
Right, because banks rely on overnight batch processing.
Exactly. When CHAPTIS closes, banks use that offline window to reconcile ledgers, run compliance checks, and calculate liquidity. If CHAPTIS opens at 1:30 a.m. or runs all day on a Sunday, that window vanishes.
You have to fundamentally re-architect legacy systems to complete massive batch processes within a tiny downtime window or run them asynchronously while the system is live.
And tokenized on-chain settlement is often atomic. You don't have a 2-day settlement window to locate the cash. The cash has to be there the millisecond the trade executes.
Which means banks will have to pre-position vast amounts of liquidity over the weekend, earning nothing, just acting as a buffer.
Plus, you need entirely new staffing models for weekend liquidity monitoring.
Which brings us full circle. You have skeleton staff because AI replaced your back office. You have $80 billion of riskier retail capital moving around. And your systems are settling tokenized trades 24/7.
Yeah.
And when something goes wrong in this high-speed, automated environment, the penalties are unforgiving. Look at Deutsche Bank. OFSI just fined them £165,000 under the new strict liability regime.
Right, for processing £635,000 in payments to a Russian app developer called OKO.
And to understand why that fine should terrify every compliance officer, we have to look at strict liability.
Yeah, intent and knowledge no longer matter. If your systems process the payment, you are legally liable, period.
Right. So Deutsche Bank processed payments to OKO. OKO itself was not on a sanctions list, but it was wholly owned by a designated company, JSC New Opportunities, which had acquired it from the sanctioned Russian bank, Sberbank.
And Deutsche Bank relied entirely on a third-party screening vendor.
Exactly. The vendor's algorithm failed to flag the new ownership structure because Russia allowed the suppression of corporate info in their registries.
But the truth wasn't hidden from the public. OFSI pointed out there were multiple open-source media articles reporting the transfer weeks before the payments.
The AI vendor just missed the news articles. And because of strict liability, the vendor's algorithmic failure instantly became Deutsche Bank's legal liability.
OFSI did discount the penalty by 45% because Deutsche Bank voluntarily disclosed it, but they noted the disclosure lacked detail.
They didn't even fully understand how their own outsourced system had failed them. The lesson here is clear. You can outsource the software, but you absolutely cannot outsource the liability. Supplementary open source intelligence is now mandatory.
Especially with the geopolitical landscape being so fluid. The UK is quietly easing restrictions on Russian oil refined in third countries right now to control fuel prices amid the Iran conflict.
The rules change daily. So let's recap. Risk, compliance, and legal teams are navigating the CCA reform, the new £80 billion growth allowance, SM and CR governance under AI restructuring, 24/7 RTGS hours, and the H2 BNPL commencement date.
It is a profound test of operational resilience.
It really is. So I want to leave you with a final lingering question to mull over. With AI replacing human oversight, just as settlement moves to 24/7 and the ring fence becomes structurally porous to fund government growth initiatives, are we building a faster, more efficient banking system, or are we just building a system capable of creating a systemic crisis at the speed of light on a Sunday afternoon?
That is the defining question for the next decade of regulation.
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.